capital, and finally, why it improves the safety of people's access to lending. So, first thing to start is to ask where do credit unions exist and why they exist. The first thing to say here is that in order to participate in a credit union, you generally have quite a large appetite for risk, and that is because the harms of anything going wrong of a person like defaulting on a loan are collateralized across the members of the fund, which means you need to have an appetite to be able to accept that risk. What does that then mean for the people who engage? First is generally they have quite a high level of trust in the members of that union, that they trust that when they take out a loan, they're going to pay it back, and that they're going to fulfill the obligations attached to that loan. And secondly, that generally the people who do engage in these slightly riskier unions are people who have been locked out of the traditional banking system in a lot of contexts. This often manifests in the poorer or regional areas of developing countries where you have, for example, subsistence farmers who don't necessarily have a steady income or don't have a credit rating or access to capital in traditional ways, which means it's really, really hard for them to do things like go to a bank and get a loan to invest in better farming equipment. So what does that mean where this debate plays out? It means that it plays out in rural and poorer areas of the developing world and is very, very rarely applicable to a developed developing context. Second thing then to say and set up is what are we going to do? The first thing to say, just like obviously, is the government is going to provide subsidies to these unions, generally in the form of providing liquidity, which can increase the amount of people who participate in the unions by both providing liquidity and then taking out loans from those unions. The second thing to flag is that the government involving themselves through the act of providing subsidies allows them to place conditions on those subsidies, meaning that you only get them if you ensure that the lending is done in vetted ways that aren't exploitative of members of those unions, but also doing things like ensuring that loans go towards projects that benefit unilaterally the members of these credit unions, which are often communities. The third thing to say is that this is an additional subsidy. It's not coming out of existing subsidies that the government is giving to other formal institutions. That's important to flag there. So, first argument in this speech, which is why we get more credit unions and therefore more people can access capital, which is really, really important. The first claim to prove in this argument is why more people participate in credit unions. The first thing to say is that people just feel more comfortable entering into and also creating new credit unions when they have the government backing. This provides a padding to the risks that exist of a person defaulting on loans, but also just gives a stamp of legitimacy to a newer or less popular lending arrangement, which it does not have the same institutional recognition as big banks. The second thing to say is that there is just more money to lend in these unions, which allows them to expand. It allows members to take out bigger loans, to do better projects, to make more money from those projects, and inevitably put that back into the union. Why is this really good? It's important to note here our framing, in that the people who are resorting to these people who are resorting to borrowing to these credit unions are generally people who are locked out of access from borrowing loans from bigger banks, from formal banking systems, which means that under our side, where we are subsidising these credit unions and expanding them, they are uniquely getting access to credit, which is something that changes in this debate. What does this look like? It looks like pooling money in rural community areas to build a school to fill an educational gap. It looks like subsistence farmers pooling their credit together to be able to buy equipment that has that they can all access and share to increase the economic productivity in the region. While this doesn't necessarily sound super sexy, it is a super impactful thing on the economic productivity of the region, where even things like just being able to buy new tools that have been rusted by exposure can massively increase your ability to do things like farm things and sell them and feed your community, which is really important. It's also important to note here that the participatory nature of these unions provides the incentive to ensure that communities do this particularly well, because you're not all investing your money into this credit union that you're taking loans out from. There is a massive incentive that you hold each other accountable, that you ensure that the projects that you're taking out loans to fund are things that are going to benefit the community, that ensure these communities flourish. This is particularly meaningful because, again, these communities are ones that have historically been locked out of traditional systems of engaging with capital. It is particularly important that we empower them. So then, even if this doesn't necessarily improve access, why does it improve? Second argument, why does it improve the safety of accessing lending? Well, it might. And so before I get into this argument, I'll take a point from.
Empirically, this isn't true. Credit unions are likely, in America, they have huge upfront costs to establish them, which is why they don't exist in poor rural communities.
Or maybe they should exist in poor rural communities, and that's why we should subsidise them so subsistence farmers I'm talking about can get access to the credit. So next argument, even why is it going to improve the safety access of lending? So while it might be true that credit unions, for example, will lend to people who went it might be true, for example, that there are a group of people who can't necessarily pay back the loans. Well, it might be true that there are people who would struggle to pay back the loans they take from credit unions, and this creates an amount of risk. And it is bad to be saddled with debt. It is necessarily good for these unions to do things for banks, to do things that isn't taking on the debt and creating that risk. However, that means that the alternative should not be that credit unions should not exist. It just means that the government have greater oversight to minimise the risk of these people entering into credit unions, because like not necessarily having a huge capacity to pay back credit should not necessarily negate the fact you should be able to access it. We hope that giving subsidies enables the government to leverage the power associated with these subsidies and involve themselves in the process. And that means like caring about what this like is spent on and like where this money goes towards. Why doesn't the government care about this in the first instance? We hope that because the people who are locked out of the traditional banking system don't necessarily have a meaningful way to organise themselves, like for example, forming a union around shared credit. The government has no real incentive to care about the ways that they spend the existing money in those communities. When the government, at the point at which the government risks their credit and subsidises these unions, or like has a stake in it, they're likely going to care about the ways in which this money is spent, which is necessarily very important. It's important to flag here that the delta in this debate is the people who would, it's not that like these people just never attempt to borrow money in the absence of a subsidised credit union at the point at which big banks lock them out. It's that they're likely to enter into loan arrangements or money lending schemes, which are just like necessarily super exploitative. This looks like, for example, going to a prominent community leader who has lots of capital and getting a particularly exploitative loan, or like going to other informal lending companies that have no moderation by the government. We know that credit unions are always going to be preferable because they have those two levels of accountability. First, in that all of the members of the community who enter into that union care about how you personally spend that money and care about your capacity to pay it back. But also, the government, at the point which they have a stake in it through subsidising it, necessarily cares about how you spend that money too. So then, weighing OG's contributions to this debate, the most important thing to know is that we have shaped the comparative that the other teams are going to have to defend. It is, credit unions might not necessarily be perfect, but they are better than entering into predatory, unregulated loans that impose like bad stipulations on the vulnerable people who enter into them. The second thing to note is that we have the highest impacts in this debate, and that is that the ability to access credit is essential to helping marginalised rural and poor communities flourish. This is necessarily important. It changes the lives of the people who live in them. Proud to open this debate.
Whenever you're ready, welcome the official leader. You're here.
Starting my speech in 3, 2, 1. The Prime Minister makes some pretty big claims. First off, it's easy to believe that the opening government cares about minorities and helping them. But they make two really big assumptions that just aren't true. First off, they just assume that credit unions are just good organizations that will do their that are just charitable and work in terms of favoring minorities. And that's just the second issue. They try to just assume that this benefit you pass on to these credit unions just directly flows onto minorities and helping minority products. In fact, that's just not true at all. The benefits of opening opposition present of what this credit union, what the subsidy would provide, is that it massively just furthers and just deals damage to overall equity in terms of harming the minorities overall. It actually just damages the borrowers through the risk that opening government has already established, and also just harms economic stability. So through these three main harms, I'll sort of go through why just credit unions are just generally regrettable, and why subsidizing them is actively counter to any harm that anything might push for minorities, and just overall harmful to wider bodies. Alright, so first off, going through this idea of equity, first we need to think about who actually benefits from credit unions, right? So credit unions already do have high upfront things, because they do care about their risk, even if they aren't for profit, they still care about not just losing money, they're not just giving away money for free, they're not a charity. And so what that means is that they have high membership fees of who can actually access it, and also they typically are pretty careful about who they lend the money to. It's not just anyone can just be hey, I'm part of the credit union, please, I want to join the credit union, just give me money at a low interest rate. No, there is a pretty high stake of who can get in, right? Maybe it's a high, you require high credit ratings, which once again the minorities probably don't have in what's been set up. Otherwise they would be able to access banks, right? Or maybe they just have to pay that upfront membership fee, which is probably pretty high and probably doesn't even offset the amount of money that they could be saving had they just gone to a regular bank where there just is not same comparative the membership fee, right? So first of all, we said that this is just harmful to equity, because the people who access credit unions aren't in fact the minorities, they are in fact the wealthy. And the moment you subsidize and you make credit unions even more appealing, have even better interests, even better incentives of oh my god, look how easy I can access even more money, look how quickly I can grow my wealth even more. The people who benefit from this change are the rich, they are the upper class who are able to already access credit unions. They're able to sort of get into those credit unions. They're able to get the benefits, reap all the subsidies for themselves and claim it. And that doesn't just go, it just doesn't at all go into minorities, right? In fact, this money could be better spent. Like if the government did care about minorities, right? They could offer it easily in two ways to cover like the exact benefits that opening government like suggests. First off, like the government can just like work on like public projects that benefit them, right? They can work on like things that are in like these rural areas. Or secondly, they just use the money and just give it as like subsidies or give it directly as grants instead of having to go through like this idea of like the credit union, right? There's just no need for that step in the middle if the government really did care like completely about like this about minorities. Because like so long as like that is like the main benefit here, it just doesn't make sense because credit unions will benefit them, and the government can just do that much easier and much more efficiently when it's done directly, right? All right, so moving on. Then like how this damages the borrowers? Well, what we say to this earlier characterization is like, well, why might someone be drawn to a credit union, right? Well, it's probably because like they can't access regular banking. Or it's like they're like, oh, like like it's lower interest, it's like easier to get money. Like that probably appeals to them, right? And so borrowing the credit, like the characterization that open government sets up, and like someone who like has a larger appetite for risk, and so like is willing to like share that collateral should something fall apart, right? But it's just overall like not a very like good thing to encourage or promote, because like that's just like a massive amount of risk that people probably shouldn't be taking, right? Because in this characterization of like who is using credit unions, if it is like the middle class who are like paying the membership fees, who think that like, oh, I really need this money, like banks probably just like more than I need that much. Well, there's probably a reason why the banks don't want to lend you that much, because like there is like a pretty big risk, there is like a pretty big danger to that. And so what actually happens is like when you bear all that risk, like the borrowers just like get hurt a lot because they are probably going to be coerced and just like they just feel like the need. Like through predatory tactics, they're like, oh, maybe like I should borrow more, maybe I need more. Maybe like they think about it as like, oh, well, if like the money is like in a sense cheaper to borrow because like there's lower interest right now. If they think it's cheaper to borrow, they might be incentivized to borrow more than they actually need at that time. And that means that they're just like trapped into a debt cycle. And like that's not like it's not as if like, oh, like you can say, oh, like it's better than like loan sharks or something. Like yeah, I guess credit unions you can say are better than loan sharks, but it's still much worse than the bank. And so as such, when people get trapped, when borrowers get trapped into like this sort of like debt, when they get like coerced into thinking, oh, I can borrow more, like like oh, it's for a good cause, like it's for an important reason. But like there's the issue of like all of a sudden like they're actually not in a good situation at all, right? Like opening government makes a pretty big I claim that like oh like banks probably are going to be the groups like lend these minorities the money, right? But once again, there's a reason for that. The credit unions need to be like so heavily vetted that they would basically become banks to the point where they can actually properly fully assess all the financial decisions they're making, are making sure that like the loans they lend out are like actually like fully risky to the same type of bank. Like they're just inherently more riskier. And something that like lends into that is the fact that like credit unions just aren't at the same scale as a bank, right? They just can't invest as broadly. They can't have like the same portfolio weight as like what a bank can do, right? As what a conventional bank can do. And when you think about it like that, well, typically credit unions exist like within like a smaller demographic. They have like a certain membership like sort of niche, right? They don't exist like fully wide scale, which means that like they are hugely susceptible to risk, right? Like if something in that portfolio, if that portfolio is down, then the whole credit union is down. It's like the risk is like fully distributed across like the same scale, the way like a national bank might be able to, right? Like there's just huge risk of borrowers. It just like isn't addressed by opening government. But, like as a result, it's a result of credit unions. And it's like the promotional thing just doesn't benefit that, right? And like I guess that also just lends into like my third point about like economic stability. Actually, sorry, before I do that, I won't take any POIs.
Do you think like credit unions are likely to loan money in a particularly risky way?
No, the issue is like there's two senses to that. Either the credit unions won't knowingly risk loan the money in a risky way, but the issue is that they aren't like the best judge of like whether or not they can't like fully judge the risk to the same degree like a bank or like national government, like a proper institution can, because like I said, they would judge the risk poorly. They were overturn the risk and like well. These people aren't actually loans either way, like it's kind of symmetric. Or they will undersell the risk, both for themselves and probably to like the borrowers as well, being like, oh yeah, no, you've got it, like you can easily make this repayment, like it's just like like a couple of like thousand like a month or something. And as such, like that is like dangerous as well. So like in either sense, because the credit unions just can't assess risk to the same scale, because they just don't have like all the same like resources and like background checks. They just can't give loans like to the same degree of like quality, right? Alright, moving on to that third point about economic stability. Well like even if I think that's pretty obvious. Like if the government like offers like this subsidy, no matter like how it's implemented, you're always going to have this idea that like, oh, there is like some benefit to it, there's some way to set it up. And as such, like there's just more growth in credit unions, right? That's something that we would see also happening if you were to subsidize them. And we think that's a huge growth, not because of not just because of the previous harms discussed for credit unions, but also because, well, like it just like also leads to worse economic stability, right? First of all, like the credit unions themselves and like all their borrowers are placed in higher risk. And also, that does just like take away like people from banks, right? Because the moment you make the credit unions even more appealing, even more widespread, well then the issue is like a lot of people are now in much more riskier places. Like banks probably have like slightly less capital, and as such like the economy is just much more like the stabilization of the economy just suffers greatly. So overall, we just believe that like benefiting credit unions is massive harm in terms of just overall like economic equity, like to the borrowers and to the economy. Proud to oppose.
TPM by observing what you're going to credit as OG's central contributions. And the first of these contributions is shaping very fundamentally the comparative that this debate must exist into, which is that obviously, as is observed and is uncontended with by opening opposition, participating in a credit union involves each member having a very high risk appetite because they are collateralizing and collectivizing the risk of their own lending with everybody else's lending. Which means that if you were someone who had access to a traditional and formal banking network, you were pretty unlikely to want to engage with a credit union. Because for reasons that exist outside of this debate, participating in a formal bank is preferable because they have more money, because they have more liquidity, because you guarantee that you'll have access to capital, because in the visceral sense that people have, it seems less sus to lend from someone like a formal bank rather than all the people in your community you're entering into a union with, which means that the people who engage in credit unions do exist in places where people do not have the comparative of less, less risky forms of lending and capital and credit that they might have access to. It exists in contexts in which the comparative for those people with no credit or accessing credit through informal lending networks which are not preferable, which means that credit unions do exist in the developing world. They exist as we described, but are overwhelmingly, no matter where they exist in developing parts of the world, pursued by people who are locked out of more traditional financial systems. They're called SACCOs in Africa, Charlie, and fuck you both, closing half, for trying to, buy this as a closing half debate by the framing. It does, by structural reasons, exist in places where there is financial risk that is discussed. Opening opposition are unresponsive to this framing. And notice that all of their critiques of funding and subsidizing credit unions fall into this trap. Number one, they observe all the facts that these have high membership fees, there's high stakes of getting in, which I guess it's unclear to me why you would need high membership fees. These are already relatively unattractive. Banks are always more desirable. If they set their memberships too high, people would access them if they're so rich and could access a formal financial institution. So it is probably, as we characterize, engaged by people in communities that seek to disperse risk when none of the members of that community are able to access formal banking networks. Secondly, they suggest that you could invest directly in communities. What's the point of subsidizing a credit union when you could just, give them a tractor or something like that? The observation we'd make is it doesn't resolve the problem of when people aren't able to access credit through a credit union, they pursue more informal lending networks. Because people have specific needs that they ultimately need fulfilled. Their credit union currently fulfills it. The government trying to coordinate very micro-level spending of communities they don't necessarily have perfect knowledge and understanding of seems pretty hard. It seems like people probably still would pursue informal lending networks in that comparative, which are very predatory, which do leave people indebted, which lead people to take out loans that are ultimately bad for them. So I don't think that resolves that problem, but it also doesn't appear to resolve the problem that it makes, the benefit, that we have, which is that credit unions uniquely, because they are collectivized, mean people make investments that are in the overall interests of all members. That means that they are invested in things that are mutually agreed by communities to be in the interests of their overall flourishing when they do decide to invest in things as a credit union and get capital for that, which the government, I guess, would have less informational capacity to do, and it seems like credit unions perform the function of providing that information quite effectively. But additionally, they suggest, I guess more broadly, there's some risk to borrowers they would enter into predatory loans. Again, if you do not subsidize credit unions such that more people can participate in them, such that they have more liquidity, these problems are only worsened. Because a person who wants to access credit and currently participates in a credit union is not a person that would or can't access a credit union at this exact moment in time because they don't have enough money in the credit unions to give that person. It's not someone who's oh damn, I can't get any credit, I'll just stop. They are the kinds of people who act in informal lending networks, like a member of their community who has incredible coercive power over them that makes them enter into the most predatory kinds of loans, or entering into crypto schemes where they ultimately lose lots of money because they're trying to lend in an extremely volatile currency whose value changes quite substantially. That lending is where the risks to borrowers are maximized, but also, it just seems basic to me that when governments inject liquidity into a system, the likelihood of that financial system, which maybe it's true, is more financially risky than a large financial institution, becoming one that is ultimately less risky, one that is ultimately more likely to hedge against the risk of a certain person within that credit union not being able to pay something back, and the whole house of cards not coming down, and no one being able to access credit. Like, it seems like, essentially, they're collectively punishing the people in credit unions who do pay back their loans by guaranteeing that if one person in the credit union fails, the whole thing comes under. But with government money, it means that you have more liquidity to kind of absorb those kinds of things, which means your credit union doesn't go under when someone goes under. The ultimate impact of this is, yes, it may be true that credit unions bear a set of financial risks that large financial institutions do not. But this resolves those problems. This makes credit unions in the status quo, which exists regardless, better in their behaviour, which means that more people can access them and actually reap the benefits of having credit for things that are in community interest. For that reason, I think we're winning the opening half, and I think we have shaped the comparative this debate operates in. CO.
Yeah, banks set up in areas to make a profit. These are non-profit, they're made by their members to grow their wealth, which means that they won't arise in these contexts you want to talk about.
I don't understand why you need to have a profit motive to, for instance, mean that members of your community flourish. I just don't understand that. Please prove it. I guess I'm going to spend the rest of my speech commenting on an argument I think CO might make, which is just like, this will take government investment away from providing liquidity to large banks, which will create systemic risk and mean more conservative lending practices of large banks, which would be bad. Because, okay, they're not going to make this argument, so I'll just shift it to the sole question of this debate ultimately becomes, do loans to people who access credit, mostly in either world, but sometimes they don't, detract or improve systemic risk? And this clearly does improve and lessens systemic risk within the overall financial systems of countries. Firstly, because governments provide oversight and informational access to credit unions, which means that the lending practices improve. They are directed to things which are ultimately in communities' interests far more often. Secondly, people are pulled out of more informal lending networks, which means that the systemic risk that is generated by them defaulting on ultimately very predatory loans is decreased. Thirdly, members of credit unions have natural incentives to hold another one accountable to make sure that their lending practices are not as bad. It's good to funnel people into those structures to reduce that systemic risk. And finally, government liquidity to an ultimately risky structure is something, providing redundancy to that system is ultimately good, which means that credit unions are more able to weather the storms of financial risk. Ultimately, that wins over the government debate on size of impact and framing. That reason,
I think OG makes a massive concession when they say that banks are the far preferable form of lending, because if this is true, then it is so unclear why we should subsidise credit unions. Because no, we do not have to defend banning credit unions on opening opposition. We just have to contend that they are really bad for the majority of people, so anything that pushes more people to opt into credit unions instead of banking is going to be a bad thing. First, I'm going to explain this issue of who opts into credit unions, and then just going to defend our material and then add a few more responses onto opening government. So firstly, to explain who opts into credit unions, we tell you that this actually probably looks like people who are middle to low class with a relatively lower barrier, with a relatively lower level of financial literacy, who are likely to be easily convinced by things like having low interest rates or low lending, and not necessarily understand or not necessarily be able to weigh that very well against banks. And empirically, I would say that this is probably true because credit unions do just exist a lot all over the world. I'm sure they maybe also exist in Africa, but if they do exist in places where banks also exist, and that would suggest that people opt into credit unions even when they have an alternative of banking. But we also tell you that they're likely to particularly be coercive because we say that firstly they need a large pool of money to function, which gives them a reason to incentivize people or encourage people to join them, because having more members increases your pool of funding. And that means they're probably going to be actively trying to encourage people to join those credit unions. But I would note that having someone join your credit union does not necessarily guarantee that you are going to necessarily be able to get a loan out of that credit union, because they are probably able to decide later, I guess, whether they give you that loan or the size of that loan. Meaning they're likely to be convincing a range of people to join that credit union, even if those people weren't necessarily, stable in their credit, etc. But importantly, at the end of this, there probably are a really small group of people in places like Africa that just have no access to banks, and sure, maybe some credit unions can exist there, but I just do not think they need any more subsidies, and I do not think they need to be encouraged anywhere else, because that is when more people are going to opt into choosing them over banking, and that was so bad for those people because of all of the risks that we tell you. And also know that given that there are other comparatives that people will take coercive loans of people in their communities, I would personally just say that if there are people that are already so coercive in their communities, probably they were either going to be a big member in the credit union who is continuing to be coercive in that credit union. It was unclear how that actually got mitigated at all. But also probably if you are making a lot of lucrative money off like taking really bad loans of everyone else in your community, it's unclear that you'd allow a credit union to exist in your community in the first place. And also I'm just not sure that these people exist, honestly. I think in small communities, people probably aren't that horrible to each other in most instances. So I just don't think this comparative is necessarily harmful or one that's actually going to happen a lot. So yeah, essentially, what we bring you an opening opposition that means that we must win is we tell you that on the outside people are more encouraged to access banks because credit unions are less widely available. We give you a bunch of reasons why banks are so much better for people. You don't have to pay constant membership fees, which probably, yes, will be relatively high given that they have to have a pool of money from which to give out loans. We tell you that banks are far more stable because they're better at making decisions and they're better at making investments. But crucially, we also tell you that credit unions are likely to be far harsher when they're trying to collect debt from people because they don't have a pool of money to fall back on, so they must make sure that you repay that loan, and that was particularly harmful for people as well. So anything that was going to encourage people to go more into credit unions instead of banks was a massive harm in the debate. But I would also say we're probably even winning if you believe that credit unions are really well-intentioned and are really beneficial actors, like maybe the best case of the credit union who really wants to help the community, because we tell you that they just do not have the resources to help people. We tell you that they don't have the knowledge that banks have. We tell you that they don't have the expertise that banks have. We tell you that they don't have the amount of people working for them that banks have, which means they're probably likely to do things like make really bad investments, or like, I guess just have really like small pools of credit because they just do not have the ability to access and sort of obtain those funds to give out to their members. That meant that they were likely to collapse because people would take risky loans that they would not be able to repay because they would make bad investment decisions and lose all of their money. That meant that everyone who opted into that credit union has just lost all of that money that they paid in membership fees. And if OG wants to talk about the vulnerable farmers in the developing world, this harm is so much worse for them because all of the money in that community has gone when that credit union collapsed. That was so bad. But a couple other responses, they also, a couple other responses, I would also just say that in these contexts, if it is the case that people are so unable to access formal institution and formal banking, that their credit score is so low that no banks in the area would take them, then I would just say that this is a further reason that credit unions are particularly unstable, because that means that those are the people who are like the least likely to be able to like repay those loans. So that was so harmful when they were when those people were more opting into credit unions. So I would say probably in a lot of cases it was just better if those credit unions didn't exist at all, because even in the worst case, even taking OG at their absolute best, it's probably preferable if that person in that community does go to the other person in the community who's maybe slightly coercive in the way that they've given the loan, but at least only that one individual has been harmed, as opposed to the whole community that gets harmed when everyone opts into a credit union that ultimately collapses because it just cannot afford to pay out all of its debt. I'll take a quote from closing.
Who makes decisions for banks?
Who makes decisions for banks? Presumably people who make decisions at banks are people who have quite a lot of experience working at banks. So I would say they're at least comparatively better at making decisions than people in credit unions. Maybe this will make more sense in the extension, sure. And then finally, I would just say that it was just in and of itself a harm to push people into paying membership fees and making contributions, because these are people that already had so little capital, because these are people that were now having to pay continuous membership fees they probably were not going to get anything out of, because that credit union was probably not going to be able to give them any substantial benefit or give them any sort of sizable loan. That in and of itself was a big harm to people who are already struggling. And then finally, in terms of the government being able to use the subsidies to encourage credit unions to be better, I would just say surely that if they were doing really bad practices, you could just introduce legislation. I don't think you need to convince them to listen to the government through a subsidy. I don't think that was necessarily an exclusive benefit. So I would suggest at the end of all of this, I think that opening government's own characterization works against them, because the kinds of people that they want to help are the people that were the most vulnerable in either world, are the people that credit unions uniquely would not help. But specifically, we tell you on our side that banks are more likely to appeal to these people in the absence of credit unions, because when people are more likely to, don't have a credit union to opt into, then the banks are more likely to reach out into those communities. Banks obviously want more people to invest in them because that is how banks make money. Whereas if everyone in that community is already part of a credit union, there is no reason for a bank to extend there. There is no reason for them to build that regional branch and try and actively engage with members of that community and try and actively get them to invest. So not only is it a passive process of people are less likely to choose banks, but also banks become even less accessible when lots of really small credit unions exist. And that was so harmful for the economic development of all of these regions. That was so harmful for the development of these regions because banks were a much better form, because we should do anything to push people to go into banks. So proud to oppose.
Let's start with two pieces of framing, which will frame out this opening half. The first of which is asking who actually provides credit for credit unions, and the answer isn't just a bunch of people come together and they give people money. It is actually often industry specific, which is to say a bunch of coal miners come together and decide we're going to provide money to other coal miners. It's like healthcare professionals coming together and say maybe I'll help provide a mortgage to someone else as well. So why is this significant? The first of which means that yes, it's about taking on risk, but generally demonstrates an incentive that they care about the industry and the growth and health of the industry. But also, secondly, it therefore means how this union operates. So often it's just tied to an existing union already with decision-making structures, which are always going to be preferable to banks. Which therefore means once this piece of framing is going to become relevant when I explain why decision-making in these credit unions are significantly better than banks. The second piece of framing is who does this actually exist? Which is to say, OG contends that it is people who could otherwise not access credit and the most vulnerable people. I would suggest this is incredibly unlikely by nature of the info side, which is to say they're issuing out very low interest loans, and because interest attaches to how much risk you're taking on, low interest suggests you're giving out loans to most credit-worthy people who otherwise couldn't look at a loan from a bank but just want to operate on lower interest rates. And the reason why the opposite is true is because firstly, high interest rates exist in case a person's in a default, because it means this bank is able to collect the principal before the default actually exists. The second thing to note here is the reason why payday loans and also like buy now pay laters are so pernicious and so horrible is because they give out loans to these people who are likely to default and charge a huge penalty rate and the interest afterwards. It means it is deeply unlikely to be the people which OG cares about. Why is this piece of framing significant? First of which is that it probably erases a lot of OG's cases, just isn't exactly relevant to this debate. But secondly, this is not actually a knife because CG is charitally engaging with its opposition bench and taking them at the very best. So, what is the actual question and comparative in this debate? This debate is about why credit unions are preferable to banks because these people in credit unions are able to offer loans which are very good to the most powerful and the most credit-worthy people and leave everyone else within the kind of jaws of bad and evil banks trying to make money off them. So, two points of this argument. Firstly, on access to capital, and secondly, on better decision-making. So, firstly, why are these loans preferable? Very simply, lower interest rates means you pay less money, is broadly better. The second question then is, why do credit unions unable to issue out as many loans as they want to, and why do government subsidies change us? Because firstly, money is pulled between individuals and companies who are part of the industry, but ultimately have to shoulder a lot of personal risk. It means that probably this isn't actually that much. It means that there is a substantial burden in opting into a credit union in the first place. But secondly, banks just clearly have more money because they are able to pull money from everyone in society as opposed to a credit union where it's locked to a specific industry. The third thing here is that credit unions are not authorised deposit-taking institutions, which means they can't invest their money and generate capital elsewhere. They also can't make a profit, which therefore means that people who put their money in there aren't able to grow and have some sort of cushion there. And the fourth reason is that often because credit unions are not the most resilient to things like economic shock, so like downturn because the market's not as favourable, or because people themselves are going through personal issues and cannot actually provide credit, means that often the amount you can offer is actually significantly curtailed compared to a bank, which is why there's a limited set of loans. This loans goes to the most credit-worthy people who are most able to pay it back. Under our side, what changes then? It means the government subsidises these loans, either by providing some money for people, by covering some of the loans which people are taking out, or by just giving the union more money so they can issue out more loans. That therefore means more people are able to access capital. And look, I'm not going to say we help the most vulnerable people in the world, but it does actually help middle class people who are still struggling to buy a house in this economic crisis. It does help that dentist who needs to buy new kind of equipment. It does help that person who wants to access things like health insurance because they work in a coal mine. This is particularly important, and I don't care they're not the poorest people. There's still people who opt protect, and these people are far more able to access these loans as compared to a bank. So how do we weigh this against the other teams? The first of which is that we weigh over OG because we identified the correct stakeholder. The second thing is that we directly engage with the context coming out of OO and say why it's better for these people. But before then, OO. CO?
Fuck upper middle class yuppies. Why should we prioritize them over taxing, lending, and savings accounts so that we can provide social services to the people that actually need it?
They also exist at the same time. I'm not sure where the opportunity cost actually exists here. So the second argument we're going to make then is on decision making. We'll just say, why is decision making better in a credit union than a bank? First, a piece of context on how decision making works. In a bank, decision making is often done by shareholders. You need to make decisions and issue out, provide like those based on what is going to be profitable and what is going to make the most money for them. And also doing a bunch of other auxiliary activities which increase the wealth of shareholders, such as like entering into particular investments. Compared to a credit union, where the way to get decisions, able to make a decision, is simply by participating and offering some money, which means there is far more ties to industry and far more ties to the community. Why is decision making going to be better for the community? The first of which is to say, those who receive a loan can actually see what the industry needs in order to improve it. Whether it is because it is a credit union run by lawyers, maybe that therefore means we should fund more family law clinics because there is a short supply of it, as compared to giving out money to, corporate law or whatever. It means they can actually allocate money in a way which is more strategic, as opposed to a bank which is far less discriminatory because they don't care about the industry as much. They just give out loans who is able to pay them back the most, who are able to target it specifically without something which is good. Secondly, I would suggest there is far less risk-taking behaviour when it comes to credit unions versus banks, because your personal finances are tighter. Compared to shareholders who don't actually necessarily care that much about who the bank is lending to, only that they're able to make money in the end, means that banks are far more likely to do way more riskier behaviours directly as one to owe, which is like investing in shitty mortgage-backed securities, or God forbid, if you have some shareholder activists in like fucking green bonds which don't make you any money at all, is significantly more risky and things which are quite negative when it comes quite negative. I think I want you a very simple example. The collapse of Silicon Valley Bank, which is a bank for tech startups for Silicon Valley, did collapse for very similar reasons, that the banks are deeply, deeply risky and far more likely to make worse decisions because the shareholders compel them to do so. The third reason as to why it's critical is that it ties the interests of the industry together. We just say people are less likely to undercut each other due to things like competition. Because if I was going for a credit union, I'm less likely to want to buck over a local dentist in my area because I probably loaned some money to them in the first place, means that I'm more likely to, simulate kind of cooperation between these individuals. When it is preferring customers because you have too many customers and giving them more clients, whether it is doing joint training or whether it is also providing and sharing expertise, etc., that is probably better for the industry as a whole, and it's the benefit we get when we tie people's interests together through things like a credit union. That therefore means, in this space, we've concretely proved to you why credit unions are actually preferable as a way for people to get loans compared to a bank, and that is why we probably squarely with this debate. But because of a few seconds left, some sort of missed rebuttal to this opening opposition. May I say at the end of the speech that now banks don't go into like rural areas? I think one, probably untrue because there's still an incentive to make money. They can simply compete with credit unions, which means that any banks who come into this area means likely to be better because competition to a credit union means that they have to, offer not as predatory loans in order for them to do well as well. So at the end of this, CG wins.
I was really worried before giving this extension because neither opening team understands what a credit union is or where they exist. It's actually closing government that's correct. Thankfully, they're on that extension, which means I can now run my extension. The issue with credit unions isn't that they are mean to poor people or abusive or pernicious, or that and it's also not that they're good because they exist in poor rural communities. Actually, the people that have the capacity to set up credit unions and enter into them are largely the wealthy. And the reason why those wealthy people get benefits from credit unions is not because they've figured out some kind of banking magic that means they're able to avoid all of the problems that exist with the regular banking sector. It's because they collectivize together as wealthy people, and then the government gives them the privilege of never having to pay federal or state tax on their lending and savings accounts, which enables large-scale tax evasion on behalf of rich people. losing a huge amount of government revenue otherwise be used for important social services that actually help people, whilst at the same time outcompeting and buying out smaller community banks, consolidating the banking sector into the largest, most pernicious forms of that banking, eliminating community banks which would actually be accessible to those poor people. Those will be our extensions. So, firstly, on setup, obviously two kinds of credit unions exist. We're going to talk about the one that is far more common, the closing government also described, which is the set of credit unions that are there to serve as rich people that exist largely in the developed world. We'll establish why those are far more common, and we'll engage more charitably with the empirical reality to explain why it is that we grow those particular forms of banks expanding, even if they do offer benefits towards the members in them. And I know the reason why this case is so charitable is because it assumes that these credit unions are good for the people who join them. So even if you believe the entirety, or don't believe any of the other stuff that's being said by opposition, or you believe the criticisms that have been levied by the government side, you believe that these are actually really good things for people who join them, we'll explain to you why those benefits are attracted largely towards wealthy people at the expense of poorer people, and therefore we should subsidise their expansion. So firstly then, why is it that these credit unions serve only to benefit wealthy people? The first reason is one that opening opposition already identifies, which is that they often require a large deposit or membership fee. The issue with opening opposition, though, is that they don't establish why it is that those membership fees are particularly restrictive, because many banks have membership fees before you join them. Why is it that credit unions have such a high membership fee that makes them prohibitive towards poor people towards accessing? Well, the reason is actually provided to us by opening government, because as they identify, when a person takes out a loan from a credit union, the impact of that person defaulting on their loan is collateralized across all of the members of that credit union, which means the existing members of that credit union have an incentive to increase the membership fees and be restrictive about who is allowed to become a member of that credit union. So allowing poor people who have less collateral and less proof of income to enter into those credit unions increases the risk of their own savings accounts, which means they do two things. Firstly, they often require an excessively large membership fee or have really large deposit limits that mean that you are precluded from entering those credit unions in the event you aren't someone who isn't already relatively wealthy. But secondly, they often restrict participation towards particular industries in the way that closing government describes. And often those industries are actually quite wealthy people, because they say coal miners to attempt to solicit sympathy from you. But the average coal miner earns $200,000 per year. They are the upper class, even if they do manual labour. And those people should not benefit at the expense of poor people either, just because they do work that gets them dirty all the time. The second reason, though, why they are restricted towards wealthy people is not just their deposit, but it's also the fact that they are geographically restricted into areas that are already wealthy. The reason for this is because when you lend out money, that money comes from the money that was deposited in that account, which means a credit union that exists in a poor rural community, as opening government described, wouldn't actually have the capacity to do any lending. Because if you exist in an area that is on net in debt, you can't lend out any money to people, because people aren't putting money into the savings accounts that you could then lend out towards other people. Because yes, people in rural communities do have savings, but those savings are offset by a larger amount of debt, which means that those communities are net in debt because they have mortgages on their homes rather than homes that either have mortgages already paid off or provided to them through inheritance. Then it's unclear to me how exactly credit unions could ever be set up in the context that they describe. And far more often they're set up in more wealthy communities. And they don't have any incentive to expand their branches into poorer communities, because allowing those people access to the credit unions would increase risk in the credit union for the reason previously described. The third reason then they're restricted to wealthy people is because even within those credit unions, the benefits of their expansion and the benefits of the subsidy go first to the most wealthy members of that credit union. And the reason for that is because when a regular bank pays out profits to its owners, this bank instead pays out profits through interest on people who've deposited money in that account, which means the vast majority of the wealth from the interest paid on loans goes directly towards the people with the largest amount of savings deposited inside of that credit union. So overwhelmingly, even within these credit unions, if poor people are able to access them, the profits that come from the subsidy don't go towards the new poor members of that credit union, they go overwhelmingly towards the already wealthy. The fourth reason then why it's restricted is that, as opening closing government identifies, they offer low interest loans, which means they require people who take those loans to be able to prove that they have an extremely high level of income in order to prove they can pay off that loan, which restricts both not just the people who deposit money in a credit union, but also the people who take it out. What that establishes you then is that the vast majority of members of credit union are already wealthy, they are upper middle class, and let's explain why this is bad to benefit them. The first, opening government.
We explain that regardless of what you believe about who opts into it, these subsidies show up liquidity in what are inherently risky financial institutions.
They're actually less risky than other financial institutions for the reason that, well, the members are wealthier, which means they give out less risky loans, so it's untrue that they're riskier, but also they're not paying corporate or federal tax, which insulate them from another form of financial barrier. And in addition to that, they don't engage in any other form of investment, which shields them up from that kind of risk. I just don't understand what you're trying to prove. Next then, why is this bad? The first reason is that it enables a large-scale corporate tax evasion on behalf of these wealthy people. Because consider why it is that credit unions are able to charge lower interest on loans and pay out higher interest to account holders. It's for the reason they are exempt from federal and state income tax, which means that those businesses aren't profiting from some kind of magical corporate trick. They're profiting from the taxpayer, because these rich people who otherwise would have gotten loans and invested in banks would be paying federal tax on that financial engagement. And it's totally unclear to me why this particular form of financial transaction, unlike every other form of financial transaction in society, should be exempt from these kinds of taxes. Because it's the government that facilitates it. And just like how we redistribute all other forms of financial activity, we shouldn't allow the rich people through this loophole to get away with engaging in this corporate tax evasion. That's money that otherwise would have gone towards subsidies, otherwise would have gone to social services. But secondly, it comes at the expense of alternative banks, and these are largely community banks. And the reason why those banks get outcompeted is because these smaller banks, unlike larger banks, are the ones that can't compete with credit unions, who are able to outcompete them because they aren't paying any federal or state tax on any of their services, which means these small community banks lose out in these areas. And the downside of that is, firstly, these banks were better for poor people because those poor people could actually access those banks. They didn't have to meet the membership requirements. But secondly, those banks are also substantially better regulated. Thirdly, those banks are actually paying a federal and state income tax. But it also knows that these types of banks co-opt a lot of the benefits the closing government described, because it's these smaller community banks rather than larger banks that do that reinvestment. So now, on their side, credit unions do that reinvestment into rich people shit. These community banks would have otherwise done it in a more diversified set of things, and they were far preferable. Don't let rich people evade tax, charge them, and don't subsidize their expansion.
The first thing I'm going to explain here is why the barrier of entry into these unions isn't actually as high as closing opposition makes you want to think. The thing we would note here is that there is a difference between providing capital to these markets and the decision-making, and like entering into the union to join the decision-making outcome of these unions. Which is just to say, usually it's only about a $20 fee to join like the people who make decisions to where these unions go, because they are industry-based. So you can not provide capital, but you still get a vote in saying where the capital goes to after it's invested. And I would note this kind of just deletes a lot of what this closing opposition case wants to be. Because, one, it means the barrier of entry to getting possible benefit from these unions isn't very high, because you yourself can be a voting member of the union and provide money from like the loans that are given to your industry to get access to like the capital that is injected back into the industry of which this union is meant to support. But it also means the directions of which the capital is like invested in and the possible gains you get from investing your capital isn't as high as this side opposition team wants you to think. First, I'm going to go through some direct response to closing opposition. Then I'm going to talk about weighing our own extension, and I'll talk about the opening side. The first thing I want to note as to why this extension doesn't actually work from closing opposition. The first thing we would note here is that Kat explains why credit unions can't actually offer that many loans. And it's not the tax hack that they want to explain, which is just to say there isn't that much capital that exists in the status quo, and the amount of funding and the amount of capital that exists to like loan people our money isn't that high. The loans that do exist are just going to people in the industry who seek to gain like ability to buy like more like tools as a dentist. But the second thing we note here is that these credit unions aren't actually the real tax havens that side closing opposition wants you to think there is. The first thing that we note here is that they're just far better alternatives as tax havens that exist in the status quo already, which is just to say which is just to say, first of all, there are forms of like hiding your income offshore or using forms of trust to get to hide the income that exists and to hide access to your capital gains tax, which is what they're describing. The second thing we'd say here is these unions are just necessarily way more risky than other forms of tax havens, which is just to say you do not control where the investment of your money goes to, and you do not control like how it is used in the meantime, which is to say, as both opening government teams say in this debate in the opening half, it just explains why these credit unions are likely to be more risky, which is just to say if you invest a bunch of your capital into these tax havens, as like closing opposition wants to say, but then there's a poor investment or something goes wrong, you necessarily lose all of your capital, which is incredibly detrimental to you. The possible gain you get of like missing out on some income tax isn't necessarily what you want. The third thing we'd say is you necessarily just get way less way less growth on your capital investment in the first place, which is just to say these are non-profit institutions. So the way they are investing this capital means you get way less return on investment of your original sum and your original capital, which is just saying the way these credit unions give out loans is to help people in the community and help people in the industry get access to their tools or what they need to survive in the industry. It is not investing the money into the most effective forms of income increasing your capital, which is just to say you get far less improvement on your original capital sum, which means you get far less growth. And notably, the way wealthy people make money in this debate is not by hiding tax from income, it's actually by growing your initial capital sum, because this is where you derive wealth. It is choosing the location and investment of your capital in the first place, which is necessarily what you lose when you go into a credit union. So it means where you derive your wealth and the way you increase your wealth as an individual who is rich is not by investing in credit unions, it is instead investing in things of which derive you the most amount of money, because you control the direction of your capital. I do not think if I were a rich person, this is what I do. But the second thing we'd say here is you don't get taxed. The next thing we'd say here is that this closing opposition team does not actually engage with how tax works in this debate. The first thing that we'd say here is you do not get taxed on your sitting income and capital that exists. You get taxed when you derive profit from this. When you take it out of the credit union, where you can still get taxed on capital gains. When you get a dividend and you get a profit from this money, which means you still get taxed as an individual who is wealthy in the status quo. This is not the tax hack that they want to claim it is. I would just note empirically, credit unions are not where rich people hide their money. It is not in the status quo where tax havens exist, and this is not an extension of which closing opposition can use to win this debate. Okay, compare that on side of closing government to our real benefits, which is to say, we get a better and more effective form of investment because the people and the decision-making process that exists in these credit unions is just better. It means in the instance where risk occurs, it means we are the ones that are better able to bail these people out, and we have more money because of these subsidies exist. And we explained why these credit unions are a far better alternative than what exists in the status quo. I'll take over.
Yeah, so surely the people involved in credit unions are equally able to influence their investing in the same way as shareholders of banks. The only difference is that banks have more money, so they're willing to take more risks. So surely giving credit unions more credit means they'll take more risks, which then harms all of their members, as we explained.
See, the difference here is that credit unions are comprised of a bunch of people who have access to the decision-making process, who are more informed in helping their own industry as a whole, which is just to explain that they are not likely to make risky decisions. They are going to invest it in the best way possible for their industry and the people collectively involved. They are not banks whose only goal is to maximize profit. They are trying to help the industry, and that distinction is where the better decision-making process works. The final thing I would note here on this closing opposition team is if they want to talk about taxing credit unions more, it's unclear why we can't also do that with subsidies. It's unclear why there's any opportunity cost in subsidizing them but then taxing them as well. It just means that they'll have more capital to give out to people so they can provide better loans. And then in instances where there is incredible tax evasion that goes on, we can get rid of that too. Why do we beat OO? The first observation I would make is first, we flip the entire point on economic stability, which is the vast majority of their lead speech. They say risk is centralized in credit unions and that there's a reason banks don't loan to these people in the first place. We'd say, one, credit unions aren't offering to risky people in the status quo. Because they have lower, as we explained at our member speech, because they have less interest rates, it does just mean you invest, you aren't going to as risky people. The second thing we just explained here is that our extension on decision making being better in credit unions shows why the risk is far less likely. Instead, we are just helping industries and the people who need access to this capital to exist as a small business. That's far better. But thirdly, it's deeply unclear why alternatives are better. If they're locked out of banks, they'll go to high interest loans from things like loan trusts and so on, payday loans. It's unclear why this is a better alternative. I do not think this stands. The second observation I would make here is their claim on low financial literacy people being coerced to join also fails. Our extension shows why credit unions are better who are trying to help their industries. It's unclear why they're going to be coercing these people. Notably, these are not for-profit institutions, so they have no incentive to coerce people into joining. Unclear why that's happening. But also, coercion, if it does exist, happens on both sides. We just subsidize it to make sure that people lose their money less in the worst case instances. I think people are lying in this debate and go to the side of reality.
Hi everyone, thank you all for the debate. Sorry the deliberation took a little while, but that's your fault for having both a good quality and close debate, but also a debate that at times had a little bit of confusion to it and a bit of messiness to it. So I think the general feedback, first thing I'd say is just, it's going to be unuseful feedback, but just try to be less messy. And I think the problem here is that there's not really a rapidly agreed to characterization of what these banks are, nor a willingness for teams to say, all right, well, these banks can exist in 2 or 3 different ways. Why is our way the most important way for the debate? It kind of seems like here's just 4 characterizations of banks, you figure it out, and we'll deal with the rest, which I guess is the job of the judges to figure it out. But it would be helpful if teams spent more time, I guess, engaging in each other's cases and doing a bit more work as to why, if that thing is true, why our side is a more important vision of that case to exist in and why it works. I think the second thing I'd say is just there's a little bit too much casual knifing going on in the closing half, and a bit of unnecessary stuff going on in the closing half. I don't think it ultimately makes any massive differences to the debate, but just like you can say things to make them sound like not knives, like putting things in different characterizations or putting them in context you think are more relevant, are not knives, but I think they'd be useful to actually just like not sound so Edward Scissorhands or whatever. Well, scissors, not knives, but anyway, yeah, in your description of those. And the last thing I think is just obviously in debates that become quite complex economically, etc., or there's multiple characterizations, simplicity is key. I think trying to boil it down to exactly what you think is the most basic form of this argument we can make, and why it means that, and make it really clear to the judges why the thing works the way you think it does. In terms of the results, then we had quite a lengthy discussion, ultimately came to a consensus decision, with the first going to CG, second going to OG, third going to OO, and the fourth going to CO. Let's step through why the call went that way. Let's start with our closing government, why they get the first, and I guess we'll work our way around the debate from them. I think the first thing that closing government do is actually provide what I think is the clearest, best, and there was dispute about the OIV nature of this, but to my perception of the OIV, the most reasonably true characterization of what these credit unions look like, how they operate, and where they operate. And I think that was particularly useful in sort of coming out of the top half debate where we're a bit unsure about what's going on. There's been some hints of POICOs all over the place that it's not there. CG, I think, provides the clearest characterization of what they look like and how they work. I think the second thing they're able to do then is most clearly explain the specifics of how these organizations work versus how banks work, looking at the credit union nature, the fact that you can buy in to make the decisions that necessarily having to have huge financial capital going in to do that. That I think has a couple of important things in the debate. First thing it does in comparison with the GovBench is I think while some of this stuff about why they have members' interests at heart is what it's similar to or in the same vein as what opening government does, I just think that the explanation of decision-making processes are a lot clearer from closing government and make it a lot stronger as to why they're actually likely to do that. I think that does also help in taking out the OO portion of the split, because given OO's case is a lot around how these companies work with, these credit unions work with such risk and are likely to be bad for their members, I think the way they explain how that mitigates that risk and ensures they don't actually act in that way does help them get up over OO's case as well. And the closing half then, I think the responses we get to the CO extension do become quite useful here in terms of like why, and so the vision that CO has of the debate around being exceptionally wealthy, high buying, etc., are unlikely to be true. And I think descriptions around like the way in which you enter these facilities, enter these banks, etc., also operate well. I think the second thing it does well is I think a lot of the rebuttal that's given to the CO extension around there being other or preferable versions of tax avoidance or ways in which we would get away with spending their money also help defeat the CO extension. And I think just help to point out, I think the holes in the CO extension that make it a bit less important or a bit less believable in the debate. So I think ultimately the responsive area there is able to one, show that like it doesn't necessarily look like the way it's going to be in that wealthy way, it is exclusively controlled by wealthy individuals, but secondly how they're set up in a way that does ensure that people who necessarily don't have that wealth are able to get in and get involved in the credit union overall. So at the end of that contribution, I think CG proves these banks are useful to the members, they operate in good ways, and they do provide benefits to people who are part of those groups. So that's why they're able to take the first in the debate. Let's then look at the top half and the 2-3 split. I think the first thing we would note here is I think that OO does do some good work pointing out why these organisations might be risky. And I think the top half we're kind of left believing there could be some more risk to this given the way they operate and the way they're structured. However, what we think the opening government does well is really, in the top half at least, narrow it down to why who are the people that access credit unions, or their conception of it being one where they can't access traditional banks, but they're still ones that need access to loans and capital, and the alternative is not a bank or nothing, it is worse alternatives, loan sharks, community lenders, etc., which I think they could have a little bit more impact just how harmful and risky those are, but I don't think those are properly engaged with. That's why people would not go to those alternatives, and that is why they ultimately end up being a lot worse for those people, so they're able to win on that side. And I think then secondly, they're able to prove that they get more access for more people can access credit unions now. They otherwise could other traditional capital streams, and the benefits of that are pretty well impacted with the examples around farming equipment, if it's like a farming cooperative, things like that. The one note I'll make about OG is I think at times some of the some of the framing of the issue of like whether or not these credit unions are at the status quo already made up entirely of people who can't access bank loans, or that this model increases it so they become more like that, does become a bit confusing. I think, but ultimately, I think even if the headings are a little bit like mismatched, ultimately the analysis ends up believing that this opens it up more access by having this subsidy to more accessibility for more poor people to get in, which then does become quite important when comparing in the long diagonal to CO. As to how it beats over the rich control of that by proving through their analysis that the government loans are the way in which we do have more lower income people being able to access. And that becomes, I think, important in the long diagonal split, because if the concern from CO is that these things are controlled by incredibly wealthy people, then the way we break this down is by the subsidy access that gets more people in there. And I think, as we'll come to in a second, I think that access outweighs the harms. So let's then look at the opposition bench. And this was I think a close split in the debate. I think OO doesn't identify, has already said that they have their bad structures, their risky behaviour, and etc. I think those ultimately stand as useful contributions in the debate. I think the CO stuff then is the contribution is firstly that this enables credit unions have the capacity for large amounts of wealthy people to just go in there, create tax loopholes, avoid their tax, and it's about the governments and then providing a further subsidy to allow those wealthy people to continue to avoid paying tax. I guess the questions the panel had around the CO extension were, one, why this was the best or most effective way in which people could avoid taxes, or that which people were already doing this in status quo versus just using banks, where already banks don't pay large amounts of tax anyway, where there are lots of other easier ways to avoid tax. I agree with there is some barrier in terms of it is easier to just go to a credit union than it is to offshore, but how much the massive difference here is quite limited. And then when I think a lot of the impacts then, the big impact at the end of that is, we can tax the credit union more, because we're not taxing individual mortgages, they're still paying interest, they're still paying tax on their interest. We're only talking here about lost tax revenue on the credit union versus the money being elsewhere. I think that's a particularly low amount in today's debate, and not impact just particularly how large that is likely to be, which I think then means it's hard to credit that as being a particularly impactful thing. So obviously, what's the word I'm looking for? I guess we intuitively agree with the idea that it's bad that rich people have a benefit, we should abolish that. But I don't think that CO identifies how the lack of subsidy actually stops this thing from happening. It just allows a thing that's already good for them to continue happening, but at least the material coming from OG allows a path to breaking that down by letting more people in a way that doesn't necessarily massively increase or change the amount of benefit that wealthy people are getting out of it. So at the end of that CO contribution, I don't think there's a significant amount left. And then what is left then is the stuff around high access fees as barriers to entry, which are things that are already explained and said by opening opposition as to why these things are hard to get into or why they have access problems for people. Which then is, again, that high access fee is less of an issue when it's subsidised by the government to access. All right, hope that all made sense. If anyone has any questions, please feel free to come and speak to any member of the panel. But thank you all for the debate. Good luck for the rest of the tournament, and we'll see you all next round.